Hello, and welcome to another Roofing Economic Outlook. My name is Heidi Ellsworth, and I'm president of Roofers Coffee Shop. And I am here today with Mischa Fisher, the Chief Economic Advisor for Angi. There is so much happening out there right now. I'm just listening to the news, watching, reading on the different things that are happening. Kind of talk to us a little bit about what you're seeing overall. I mean, especially around, people keep throwing this recession word around. What are you seeing?
Sure. And recession is one of those things that kind of felt like it came out of nowhere for a lot of people. There was no discussion of it, and then all of a sudden there was. And the reason why is because the Federal Reserve is raising interest rates. And what that really practically means is they're making the cost of debt more expensive. And a lot of businesses expand on debt. They fuel their hiring and their buying based off typically of credit. So those things are going to get a little bit more expensive. And as a result, consumers who are also using debt to do things are also going to face some pullback. The Federal Reserve thinks that they can raise interest rates and maneuver what's called a soft landing. So they will slow down the rate of growth, but they won't actually cause any retraction. Some people are skeptical because that's never happened before. It is true that the Federal Reserve has raised their interest rates and not caused a recession, but it's never happened when inflation has been as high as it is now. And whether or not it happens or not, I would encourage your listeners to take everybody's advice with a certain grain of salt, because we just don't have enough data to know. That's the challenge with macroeconomics, is that you're dealing with very, very small sample sizes, right? You can look at the last 2 or 3 times it happened, but that's not really enough to reach a firm conclusion. So only time will tell exactly what happens. But that's certainly where the debate has come from and why people are concerned about it. We did just see that the economy did contract in the first quarter in terms of GDP. Whether or not that happens for a second quarter in a row, we'll know in the next couple months.
When you say the differing variables, to me, when you look at 2 years of COVID and you look at the material supply, material shortages, I just kind of want to hone in on what you just said, because this really isn't, we don't have a historic precedent for where we're at, truly, right?
That's right. And that's why, people will say what they want to say, but there's really not enough data to say what will happen. So that's why I always encourage some degree of skepticism. And it is certainly conceivable that we could see this based off of debt getting more expensive at this rapid rate. But on the other hand, we have a lot of job openings and there's a lot of home equity, and those things can act as a cushion that could in fact allow us to avoid a recession. So we'll have to see.
Many contractors who are listening to this already went through the Great Recession. So we all dealt with that, in 2008, 2009. How does this look different from that? Or is there any way even to compare?
It's a very different situation than that period of time. When our industry went through the Great Recession, there was a lot of people that got burned pretty hard because it was a housing recession, right? So it really impacted new home building, it existed renovations of existing homes, it impacted the whole supply chain. That's not where we're at right now. In this case, it's true that house prices have been appreciating in a pretty strong manner, but a lot of that's because interest rates dropped. So it became pretty cheap and to buy a house, and the rational thing to do was to bid up the price that you were willing to pay for a house if you could lock in that house at a 3% mortgage. So that made a lot of sense. And if you look at the credit rating of buyers, it's very, very strong. If you look at home equity that people are putting down, it's a lot more than zero, right? We haven't seen these loans where people have no credit. So I think that housing is on a lot securer of a footing. And on top of that, we also have these demographic tailwinds that you and I have talked about before, where you've got a lot of people in the millennial generation who are still entering that peak family formation period of their lives. And so that serves as a natural source of demand. And at least for the next 10 years, the boomers are still largely in their homes. And as a result, there's just limited supply. So I think that right now the demographics support it. And if you look at the actual fundamental financial aspects of it as well, credit scores are solid, home equity is solid, down payments are solid. So I don't think we'll see anything like what we saw in the last recession for our industry.
Interest rates are going up. What's some advice you have around kind of dealing with those interest rate hikes and making it work within the business and with customers?
I think the biggest thing is make sure you're shopping around for those services. Make sure that you are looking at the entire range of options you have, not only to fuel your own expansion, but also if you're offering financing to consumers. Because when you see rates going up like this, it sort of is a more volatile period. And as a result, you can potentially get a better deal or a worse deal, right? That's what happens when you get high variability. It means that different people are offering different things. So that increases the need to shop around. In a really stable environment where everything's kind of the same, shopping around isn't as important because everybody's kind of offering the same deal. Right now, I think you're going to find that the deal that you can get from lenders is going to have a wider range of potential outcomes. And so really make sure you're shopping around. And then of course, if you're a business owner who's fueling your own business off of your credit card, make sure you're paying attention to that, not carrying any float, because if rates go up across the board, your credit card could be included in that. And so you want to make sure that you're really tapping into those different options. For consumers who are looking to finance projects, I think home equity really is going to gain a lot of potential from that. I don't think you're going to see cash out refis anymore because people don't want to refinance a mortgage at the higher rate.
Right.
And so as a result, I think you're going to see those HELOCs and other similar products become pretty important for a lot of consumers as they tap into the huge amount of home equity gains that they've gotten, and then also take advantage of the potential for lower interest rates on that cash effectively relative to their other options.
And there still seems to be a backlog of demand for home improvement. But what are you seeing on the demand for remodeling, improvements, all of that?
That's a great question. I think that the home equity piece is pretty strong in terms of flattening things out. We also have survey data that points to consumers having foregone doing projects because of the price of materials or because of COVID concerns, still lingering to this day. So that is an area where I think we'll see a demand smoothing. I do think some renormalization would be good for the market. It's not healthy for the market to have pros with these huge multi-year long backlogs. That's not how most markets work, right? If you go to the electronics store and try and buy a phone, they don't tell you you're going to have to wait a couple of years. They try and sell it to you day of. And I think that that's how a good market works. And so quality pros are in many cases booked up that far out. And so I think some renormalization would be great. In terms of pullback, it sort of depends on how you want to look at it. If you look at overall consumer spending, it's about 9% year over year growth, which is a pullback certainly from 13% a month or two ago, which is also a pullback from 30% a year ago, but it's still 3 times what it typically is year over year. Typically, consumer spending grows by about 3% year over year, which is a little bit more than inflation, right? And right now it's 9%, which is a little bit more than inflation. So it's sort of more like it's coming back to normal in terms of general consumer spending. If you look at spending on things like building materials, which is kind of a good proxy for what consumers are spending on their homes, that has been pretty flat in terms of the growth rate. It's still at an overall elevated rate, but it's no longer climbing like it was before. For most people, the price of a home isn't just the price of the home, it's the price of the home plus the mortgage, right? Unless you're buying 100% in cash, the sticker price is only one of 2 very important factors. The other factor is the interest rate, right? If you had the choice between buying a $500,000 home with a 1% interest rate or a $100,000 home with a 200% interest rate, you'd be better off getting that $500,000 home, even though it's 5 times as expensive. So that's an important thing to recognize. As mortgage rates go up, I think they're approaching 5.5% this week, then that's going to put serious downward pressure on the underlying price of a home. There's also the other thing that goes on with home prices, which is that the mix of homes on the market can change, right? So it could be that certain price ranges are coming on the market at a faster rate, which is going to lower or increase the overall average market price in a way that's not actually changing the underlying price of a house. So both things can go on. I think right now we should expect the rate of increase on home prices to come down considerably. Whether or not they actually decline in real terms, controlling for the quality of a home, I'm a little more skeptical that that will happen because of inflation, right? Inflation, I think, will serve as kind of a floor for quality adjusted home prices, but certainly don't expect 20% increases in prices this year because A, that's just not sustainable in terms of getting new buyers into the market. But B, a lot of those increases were because interest rates dropped so much. Now that they're going up, we should expect some flattening out of those increases.
What are some key points that roofing contractors or all exterior home improvement contractors should really be focusing on when they're looking at their books and they're looking at their business this year?
I think they should be focusing on a couple of things. One is make sure you're protecting your profit from inflation. That's really huge. I think I saw some news today that one of the big flooring manufacturers has to file for bankruptcy. That's terrible to happen when you've got a booming market for your product.
Yeah.
But if you don't protect your bottom line, if you don't protect your profit from your input and your output, then it doesn't matter that you got booming demand, right? If you've got great volume, but your profit goes to negative, that's not a good thing. And so you want to make sure you're really protecting your profit. And that probably means raising prices to at least make up for the general rate of inflation, if not more, right? Because if you are talking about some of the categories in the overall home improvement, housing, roofing space, there's lots of things that are increasing in price much more than the 8.5 average. And then the other thing is, like I said, if you're fueling your business with debt, whether it's your credit cards or a business line of credit or a loan from the bank, whatever it happens to be, make sure you're shopping around to get the best rate of that. That also serves to protect your bottom line. And then also recognize that, there's still underlying demand in the market. So I don't think people have to be worried necessarily about a 2008 repeat. I think that seems very, very unlikely. We could see a recession, we could see some softening, but the fundamentals in housing, at least, are pretty different than they were in 2008.
Excellent. Thank you. Thank you so much for your wisdom and for sharing this. And I'm very excited for the next episode because every time we talk, something different's happening out there in the economy. So thank you for that wisdom that you're bringing to all of our roofing and home improvement professionals out there. And thank you all for joining us today. This is coming to you every 5 to 6 weeks. Mischa and I sit and talk and really talk about the economy. Please send us your questions. We want to know what you would like to know, and we will share that with Mischa. So thank you so much and have a great day. We'll see you on the next Roofing Economic Outlook.